One of the things investors need to be thinking about is to look for dependability. If you think about what the Fed's job is, right, it's to maintain price stability and actually to maintain employment. Those are very, very hard things to do in this environment right now. So that's really what its overall mission is. And right now it's looking at high inflation and prioritizing that.
The Fed is going to be successful in bringing inflation down, but it's going to do so by slowing the economy down. And what that's going to mean is that in a year or two, they're going to be cutting again. The difference between this Fed and previous iterations, particularly previous iterations in the 80s and 90s, is they're telling us exactly what they're going to do far out in advance.
One of the things we've been thinking about is what data the Fed is looking at and what data gives it highly accurate forward-looking views on the economy. And clearly we think that housing is one of those in the United States. The home builders have not been able to meet the demand for new housing, even though that demand has grown over the course of the last 8 years. So all of that suggests to us that what we're about to see in terms of house price declines will be relatively modest because the supply-demand dynamics are incredibly good. That doesn't mean that home builder shares can't fall, they already have. But the fact is that there is no housing crisis that's being foretold in the US at this time.
The story of the first half of this year for markets has really been about repricing risk assets to, including equities, to a higher interest rate.
When we look at the high yield index, and we will be spending more time looking at that going ahead, there are definitely vulnerabilities in areas like, borrowers like airlines, by cruise lines, by people in the retail sector that are over leveraged, who are going to suffer, I think, in a slightly slower growth or negative growth environment that we see coming ahead.
There's a pretty good relationship between sort of year-over-year changes in the S&P and earnings revisions, but we tend to see the market lead revisions and not the other way around. So it's certainly implausible, and pretty much everyone who's looking at markets from a top-down sort of macro perspective thinks that bottom-up expectations for 10% earnings this year and 10% next year is pretty unrealistic. And the market agrees with that. You can see that the market is basically already pricing in negative revisions, even if the analysts are dragging their feet in getting there.
The one exception in the world where we can see a depressed economy moving more rapidly out of phase and into growth is in the area of China.
The major global central banks in the world, the Fed, the ECB, the Bank of England, are all tightening aggressively. The only exception to that is the People's Bank and the Chinese government, which is aggressively easing. The goal is to have the economy start to recover after a pretty challenging period of lockdowns in the Chinese domestic economy.
We're at that tipping point between what we talk about as a recessionary scenario or a resilient scenario. What will determine what we go into a recession, ironically, in our view, is actually whether or not rates rise beyond the expectations that the Fed is actually predicting right now and what that might mean for market performance. So one of the things investors need to be thinking about is to look for dependability. If you can find dependable sources of returns in the form of interest payments, dividends, exposure to the right parts of the market, reliable companies, especially larger companies that can sustain growth in this market, and also then to consider 6 months down the road whether or not these stocks and others will actually give us future recovery potential. So we want, if you will, a conservative portfolio today and a slightly more aggressive portfolio tomorrow.